The information discussed in this presentation is current as of the date noted, is for informational purposes only, and does not intend to address the financial objectives, situation, or specific needs of any individual investor. Any information is for illustrative purposes only and is not intended to serve as investment, tax, or legal advice, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Results will vary, and no suggestion is made about how any specific solution or strategy will perform in reality.
Thank you, Ryan. It's great to meet everyone here. As Ryan mentioned, I'm Mark Abdalla, an equity research analyst. I've been with John G. Ullman since 2018. And I'll be giving an update on the market and also the economy today through this webinar, starting off with the fixed income market. And I think this is a really important indicator right here, the 10-year Treasury yield that we see, because it not only moves the fixed income market, it moves the equity market as well, in addition to other investment asset classes. It impacts mortgage rates, it impacts the cost of debt, which also impacts the cost of equity. And with that, it can really have real impact on the company financial planning and the expenses and the revenue that comes with that. So this is a key monitoring point for us, the 10-year Treasury yield. It has ticked upwards above 4.5%. In fact, as of this morning, when I checked it, it's at 4.7%. So it is getting a little bit higher. You see down in 2021, right after COVID, it was at 1.5%. There was a lot of quantitative easing at the time. The Federal Reserve was lowering interest rates, stimulating the economy. Now we're seeing the opposite effect in terms of monetary policy. We're seeing these interest rates, and with that, the 10-year yield tick upwards to 4.7%. Also, what's not shown here is the 30-year Treasury yield. So that's the government debt over 30 years. What rate are they paying? What rate is the federal government paying for debt for over 30 years? And it's considered risk-free debt because risk-free investment because the government can raise taxes or even print money to pay it back. So it's kind of the baseline for all the other cost of debts that are out there. And the 30-year yield is above 5%. Actually, as of this morning, it's at 5.2%. And the 5% threshold for the 30-year yield used to be considered a ceiling for the yield, meaning that the 5%, the rate, it wouldn't go above that. It was a ceiling for the government to borrow at 5% or less over 30 years. Now it's more of a floor. So now what fixed income investors are saying is that yields are going to stay above that level for quite some time. And when it drops below 5%, it tends to bounce back up. So that 5% is acting as a floor for the 30-year bond, meaning that the cost of borrowing is going to be higher for longer. So we can expect higher borrowing costs for longer. So if you're thinking about taking out a mortgage over 30 years, that's benchmarked against the 30-year Treasury bond, and that's going to be higher for longer. The expectations there are higher yields for longer durations. And that could impact the entire market. So that's why I like to start with the Treasury yield. And I look forward to any questions you have after the presentation. But this is a key point where the 10-year Treasury yield is. It's at 4.7% right now. If it goes up, if it spikes up, we would expect the stock market to come down. So it's a key monitoring point for us. We could move to the next slide, Ryan. So the next slide is on the stock market. So the stock market, as defined by the S&P 500 index, which covers 500 stocks, has a total return of 10% year to date. Actually, this morning, the stock market's down a little bit. So it's total return over year to date since December 31st last year is about 9% right now. And it's still done very well over this 6-month time period. So, and even going back to 2021. So stock markets performed very, very well. What's been driving the stock market in 2025 was the AI investments, the hardware and the software technology that came with AI did very well in 2025. And then in 2026, the technology sector is still doing well. It's up 16% year to date. So it's outperforming the overall market. So it's and helping to drive this index forward. The technology sector makes up 35% of the index. So when you think of the S&P 500 index, 35% of that is technology, and that's up 16% year to date, helping to lift that return. But what sector has really outperformed in terms of the overall market is energy. Energy is up 32% as a sector year to date, and it's up this morning too because the price of oil is going up. So energy stocks have really outperformed the market year to date. What's interesting about energy and the S&P 500 index is that energy only makes up a very small percentage of the index. So if you purchase the S&P 500 index, if you buy it today, you're only buying 3% of energy. So it's 3% of the index is in energy stocks, and it's up, and those energy stocks are up a lot. So if you think energy is going to do well, you may want to just invest in energy, not the S&P 500 index. Kind of the key takeaway there is the index doesn't have too much exposure to energy, has a lot of exposure to technology. Technology has done well and outperformed other sectors. Energy has outperformed even much more this year. And I'm happy to say here at the company, we out of that $1.5 billion of assets under management, a good chunk of it is in energy, and those investments have done very well, right? So the price of oil as of this morning is $98 a barrel in Brent. Uh, by Brent and WTI is a little bit lower than that at around $91 a barrel. So we're seeing the price of oil rise. We'll get into that a little bit later. I have a slide on oil. But with that, energy stocks are doing well. Some other sectors are not doing well because of the higher energy costs. In particular, consumer discretionary companies they actually have negative performance year to date. So that performance from consumer discretionary stocks is negative. It's actually pulling the index down. The consumer discretionary sector has not done well. Consumers are essentially uh, worried about the economy. The consumer expectations have come down, and they're not spending as much as expected with these higher costs that they're seeing. So as a sector, consumer discretionary has performed poorly and has actually weighed the S&P 500 index return downwards year to date. So you have a mixed bag with the S&P 500 index. Some sectors have done very well, some have not done well. But overall, the index is up 10% year to date. One key monitoring point for us is the inflation rate, and we've seen it spike up to 4.2% as of Q2 2026. So this is the latest read on inflation. And you see that's quite a bit higher than where it was at the beginning of the year. You know, the Federal Reserve has a target of 2%, and it was at 3%, trending down to 2% actually. So it's in the right direction. But now you do have higher costs of energy, higher costs of debt. With that, inflation has picked up. So this is a concern for the overall market. You'll see in 2022 here, when inflation reached over 9%, the stock market did correct. So the stock market is very much impacted by this inflation rate, and it's a key risk for the market. If it spikes up further, we can expect more volatility in the stock market. So it's a key monitoring point for us. Getting into the components of the inflation rate, the same way we got into the components of the stock market index, you can see 42% of the consumer price index comes from the cost of housing. So essentially, how much rent are you paying, or rent equivalent, meaning how much you're paying in mortgage every month. That's the bulk of inflation, of the inflation rate. I mean, that's 42%, almost the bulk. So that's by far the largest category here. And in the following categories are transportation, which is your car payment, the cost it, it takes to transport yourself. So that also includes the cost of gas, which has gone up. We see it in at the gas station. Gas prices are higher year to date for sure, and recently too. So we may expect to see higher inflation rates if the cost of transportation and the cost of housing goes up. So that's really the key monitoring point. So with that, uh, the inflation rate is sensitive to the price of oil, and and that can impact the stock market. So the Federal Reserve has maintained a steady discount rate this year. You see, it came down from the highs of 2024. So essentially, they were trying to stimulate the economy by lowering the cost of lending. The problem is they can't continue to cut rates if inflation picks up as it has. So there was earlier in the year, there were talks of when the Federal Reserve would cut next, and they decided not to cut rates, essentially because they're concerned about higher inflation rates, and we don't expect them to cut rates anytime soon if inflation continues to stay above uh, their uh, their stated rates. So with that, we see this as a driving force of both the fixed income market and the stock market. The Federal Reserve and their decision on how much to stimulate the economy or to be more hawkish against the inflation rate. The other main tool the Federal Reserve has is their balance sheet. And essentially, when they want to stimulate the economy, they can insert money into the economy by buying treasury bonds or mortgage-backed securities. And they've done that through their quantitative easing program. And you see their benchmark, their balance sheet. You see here in 2022 really expanded quite a bit to $9 trillion. So that M actually in this chart actually stands for trillion. So they expanded their balance sheet to 9 trillion. Inflation picked up, as you saw in that other chart in 2022. Some people, many economists, will say that inflation was higher. Part of it because of the Federal Reserve's balance sheet expanding. They were inserting too much money essentially into the economy, which was creating inflation. Prices were going higher with that money circulating around. And with that, they've tightened up their balance sheet and through the same process in terms of letting those treasury bonds that they purchase expire. So you have some unwinding here. And with that, their balance sheet shrunk to 6.5 trillion. So essentially, they took out 2.5 trillion from the economy in terms of monetary supply from 2022 to 2026, trying to keep that inflation rate down, really trying to combat that inflation. But recently, you're seeing it tick up a little bit to 6.7 trillion as of the latest read that we have here on this chart. So a key monitoring point for us, there's a lot of focus on interest rates and what's happening there, but this is also a major driver in terms of the monetary stimulus being inserted into the economy and something we monitor closely. The other key economic indicator for the Federal Reserve and for investors is the unemployment rate. And with that, you've seen it tick up recently to 4.27% as of Q2 2026. But looking at the historical context here, going back to the 1950s, you see it's still a very low rate. So unemployment isn't one of the major concerns right now for the stock market. And you can see it has been in the past during the pandemic. You see this unemployment rate spike up above 14%. So it reached a high in June of 2020, 14.8%. And that did cause a recession. We had a recession then. You can also see it spike up here during the Great Recession. That was 2008. You see the unemployment rate spiked up shortly afterwards there and reached 12%. So very much a driving force and a key indicator for the economy. Something we also monitor very closely. Something the Federal Reserve is monitoring when they decide how to change interest rates, which would impact the bond and equity market. In addition to the unemployment rate, the other key labor market rate that we monitor is the labor force participation rate. This is out of all the working age population, out of all the people that can work, what percent is actually participating? What percent is either working or looking for work? And 61.9% is. So it is range bound here. We haven't seen too much movement in this number recently, except for COVID. COVID, it did drop a couple of percentage points, which was significant at the time. So not only was the unemployment rate high, some people decided to leave the labor market altogether. And with that, you saw the rate decline a little bit. The price of oil has been very volatile this year. So this chart was updated just a couple of weeks ago. It's a pretty recent chart, but the price of oil is a lot higher now, just from the past few days than when this chart was published. So you see price of oil here on the chart at $71. Actually, WTI is more around 91 now. So price of oil has jumped. So that's a big percentage change for an input cost for a lot of companies, and also, of course, the price of gas. And it's really impacting the U.S. market, but also the global markets. If you invested in energy, you've actually done pretty well, with the increase in the price of oil. So it's something we monitor quite a bit. Like I said before, we do have a decent amount of investments here at the firm within the energy sector, and they've done very well based on the price of oil coming up. So we are monitoring geopolitical events that happen. We see what's happening in the Strait of Hormuz, but also in the Red Sea with the other choke point there, coming from the Bab el-Mandeb Strait. And we know Saudi Arabia has a lot of oil production that they can produce, but essentially it's being bottled up there. So it's a little bit of a bottleneck. And with that, less supply is coming to market. We're seeing inventories across the Strategic Petroleum Reserve reach concerning lows. So it's a key risk for the economy and for the market on the disruption of the supply of oil. And we read the headlines every day, and we see what's happening. It's something we're monitoring very closely. We saw when the memorandum of understanding was signed by President Trump and Iran, the Iranian leaders, the price of oil dropped from $100 to that $70 mark. So you can see that here in this chart, how price of oil goes up quickly, but it comes down very quickly as well. Refiners have actually done very well based on that volatility. They can price the gas high with the price of oil going up. And when the price of oil drops, the price of gas doesn't drop as fast. With that, we're seeing strong earnings from refineries such as Valero. Also, integrated oil companies such as Exxon have done very well. Oil and gas exploration production companies such as EOG, Diamondback Energy have done very well. Even natural gas companies are doing well with the LNG, liquefied natural gas, that's in Qatar with constraints there. So LNG prices are up. And with that, natural gas prices um, have been have been beating expectations, and natural gas production companies have done very well recently. So there's volatility in this space. It's something we're monitoring very closely. There's a lot of research that goes into uh, the price of oil and where it's heading, and how that'll impact our investments. The other key metric that we look at are the leading economic indicators that come from the conference board, and they've been mixed actually. So you see the leading economic indicators here in this chart. They fell in 2022. That's when you saw inflation come up and the stock market did poorly. And with that, leading economic indicators, uh, uh, they went below zero. When they drop below zero, it's kind of a red flag for the economy. Historically speaking, it's led to a recession. So you see in 2020 here in this chart, it's the number is below zero, and there was a recession in 2020. So it's an ominous sign for the economy, but it is trending positively towards that zero number. And the indicators are mixed. So some of them are positive for the economy, or a positive signal for the economy, such as the stock market. The stock market being up 10%, that's one of the leading economic indicators within this group. And you see it's boosting the overall LEI number. In addition, the fixed income market, it used to, just last year, the yield curve was inverted or very flat. And now you're seeing more of a normalized yield curve, meaning long-term interest rates are higher than short-term interest rates. And that's a positive driver for the economy, a positive indicator for the economy. Actually, leading credit index has shown positive momentum recently. That's a leading economic indicator. But what's more concerning are the consumer expectations. As I mentioned, consumer discretionary companies are not doing well right now. Consumer discretionary stocks haven't done well year to date, and that's because average consumer expectations are indicating a negative performance for the economy. So it's taking away some of the optimism there for the economy, given that consumer expectations are trending negatively. Also, building permits are an economic indicator. The more building permits that are out there, the more confidence there is in the housing market, and the more risk construction companies are taking. And that's considered to be a key leading economic indicator, how much housing construction there is. And that's, we actually have a slide on that on the next slide. That's been trending downwards. Yeah, you see it here. This is pretty concerning that the building permits have dropped from that 1.5 million number to the 1.2 million number here recently. So there is less confidence in the housing market, less risk being taken by construction companies, and they're filing for less building permits. And that may be due to higher mortgage rates, right? The higher cost of debt. Housing, a lot of it is dependent on the cost of debt, and that is coming up with those higher interest rates.
Thanks for watching. If you found this video helpful, give it a thumbs up and hit that subscribe button so you don't miss future updates. Looking for more insights like this? Head over to our website at jgua.com for additional resources. And if you'd like to talk about your personal financial goals, we'd love to help. Just visit the description of this video and find the Schedule Your Consultation section. Thanks again for joining us. We'll see you in the next video.